Market Hustle community, welcome back to another episode. I hope you are having a great summer. Today, we're actually bringing back a familiar guest, and that is Chase Prather, to talk more about private markets. And if you're not sure what private markets are, these are basically companies that are, you can think of them still in the early growth phase. They haven't yet gone public, meaning you can't actually buy them on regular stock exchanges like Fidelity or Robinhood. You might remember Chase back from episode 41. He's a venture capital research associate at ARK Invest. So he has quite the experience in this space. And basically what he does is he helps evaluate and invest in these private companies before they actually hit the public market. So we're always really excited to talk with Chase just because we can get some more insights around how the private markets work and maybe learn some stuff about the private markets that you could actually bring to public markets in a sense, right? Especially when you see these IPOs. It's like, I get people all the time that reach out like, oh, should I invest in this IPO? Should I invest in that IPO? It's like, well, if you know how to evaluate these like earlier stage companies, you might be able to do so and make better decisions. So always great to bring on experts in different areas of the stock markets. That being said, before we officially welcome Chase back on, I want to check in with our two co-hosts today. Let's check in with Pierce. Pierce is sitting back with a nice, beautiful background, with some trees in the background. How are you doing, Pierce?
Doing well, man. Just recovering from our previous podcast in New York. That was an absolute hit. Other than that, man, life is good. Just enjoying the weather in Southern California.
Good stuff, man. Yeah, this is our first remote podcast back in kind of the routine of these again. That New York podcast was incredible. Great experience and a lot of fun actually doing an in-person podcast with the whole team. So good to have you back. Fernando, how's things in Florida?
Things are going good, man. Thankfully, no hurricanes yet. And definitely, like Pierce said, that episode was awesome with our guest that we had on there. And also, thinking out loud here, I'm enjoying this market right now where it's at and going to the bullish side a little bit. So definitely a good time and enjoying as much as I can.
Awesome stuff. Yeah. The 2025 market is definitely heating up. So, and it's kind of crazy to think back how fast things have shifted even since early April, right? Like a couple of months ago, the conversation was on the complete opposite ends of people predicting the next Great Depression. And it's like, now here we are sitting at all-time highs in most of the major indexes. So crazy stuff. Cool. Well, hey, great to have you back. Now for the audience, if you're listening to this podcast, you probably already know a thing or two about public stock markets, right? Like you've probably heard about NVIDIA, Apple, Google, and these are all stocks that are trading on regular stock exchanges like Robinhood or Fidelity. We can actually access these as investments. But here's the thing. Most people don't realize that I think the last stat I saw was like 99% of businesses are not public. Like they're actually private. That means that regular investors can't actually invest in them, at least not directly. So what Chase does is he works on a team that basically invests in these companies, some of these private companies or these startups before they actually go public. So this conversation is going to help give us a peek behind the curtain. So I'm really excited for this. But Chase, hey, welcome back to the podcast. And for those who are just getting kind of introduced to the private markets, did I leave anything out there?
I think that you used, I think that you set it up quite well. But that said, I don't think, most of your listeners have definitely heard of a lot of these private companies, and maybe they don't realize that they're still private companies oftentimes. One of my friends that works at SoFi had mentioned to me, he said that the most searched stock on their platform for a while isn't even a stock, and it was SpaceX. And then following that, OpenAI is another name that they often get searched on their platform. That's also not a public company, so you can't purchase these companies, as you mentioned, on a exchange. And there are ways to purchase them, but typically the way to purchase them would be through a venture fund, so in the private markets. And I think you often hear about these secondary marketplaces on the private side, where secondary market is where people are exchanging shares in private companies through secondary transactions through a broker. I would say a lot of companies, when you're looking at these secondary markets and see these shares available, just be very careful with the way that you're going about purchasing companies, and make sure that the fund manager and whoever you're going through is very reputable, because it's the same thing with crypto. For example, there are a lot of rug pulls, a lot of people purchasing things that weren't real, or there's transfer restrictions on private names. So oftentimes purchasing shares that are on these secondary platforms, if the company doesn't approve of the transfer or the trade of those shares from one manager to another or one individual to another, then the fact that you actually own them is kind of up in the air. So,
gotcha. Okay, that's interesting. So it sounds, and maybe let me kind of say it another way, the private equity world, or even some of these shiny objects, startup stocks that everybody kind of knows about, which is OpenAI, SpaceX. These companies, not those specific companies, but private markets in general, like you're just saying, to be more cautious because maybe there's less transparency behind the scenes. I mean, think about the public stock market, right? There's a lot more regulation. You have the SEC, who requires companies to be very transparent with their financial filings, compared to private markets. I'm guessing that's more up in the air, where maybe that's your job, Chase. Is you're trying to dig into the details with these companies and trying to find try to cut out some of the BS, so to speak. Is that kind of fair to say?
Yeah, and oftentimes, we stand on the principle at ARK to only invest in companies where we have access to the management.
My question, Chase, I know you mentioned, there's starting to be more access for, your general retail investor to have access into private markets, right? Like SoFi, for example. And there's minimums that people can use to, get access to an OpenAI or SpaceX. Now that you mentioned a little bit on the risk, and that's what most people see. Most retail investors or any investor tries to hedge as much risk as they can, right? Not to lose money that they worked for so hard. So when I think of this access, would you say that the risk, if this company decides to go public, say SpaceX decides to go public, or OpenAI, or these other ones, there's also Databricks, becoming massive private companies, do you see a risk if they become public from them even shifting to doing something else? Do you know what I mean? So say OpenAI decides to go in another direction, and then that puts everybody at risk when they become public. Of course, the private stakeholders also, are they both at risk, or is it too saturated right now for people to get in? Mostly also the stock market, people are seeing, stock market getting so high, it's hard to find the entry point. So I don't know what your thoughts are on that.
You look at some names, the names that you mentioned, OpenAI and SpaceX. If you can look up their valuations, they're public. They're both well over $100 billion valuations on these companies. I would say do your own research, find your own conviction in names. We invest really based off of CAGR here at ARK. So compounding annualized growth rate. For people who maybe don't know what that means, essentially, the way that we look at these companies is we have to have a certain CAGR number and be able to achieve that with our modeling. And I would say a conservative model as well for us to make an investment in that company. Some of these companies, it's a good question because, some companies, I wouldn't say that, we're investors in the two companies that you said, and we're big fans of them and believe that they're going to continue to grow. But that said, there are, some companies that maybe have capped out on their growth, and maybe, they go public and they grow, but at a slow rate. And, some stocks are going to be stocks that you invest in for that growth stock. And then some stocks are going to be stocks that you invest in because they're stable and they have this more so like a value stock that you can kind of count on this stock to continue to be, a good egg continuously. Whereas, growth stocks can be a lot more volatile. I mean, I think of, private markets are very, very volatile. Even though the pricing doesn't quite change every single day, the changes in the company happen so quickly because, with some of the large language models, this is a good example, the valuations of these companies have grown so fast, but the progress of these companies has gone very, very fast as well. Their revenue has, shot up quite fast. Their user metrics have shot up quite fast. And we haven't really seen much of that tapering off for the most part yet. So I think if you have conviction that the company is going to continue to grow at a rapid pace, and you think that there's still growth within that company for upside valuation, then I would say, obviously do your own research, but if you can, lead to those and find conviction in the company, that's where I would at least start.
So I have a kind of basing off of that. What is the risk and kind of over projecting, over evaluating the CAGR, the growth in it, and how does ARK manage that? If something is overvaluated or over projected, what does that do for you guys, and how does that affect the investors?
So you mean more so if I look at a company and the valuation that's set on the company is overvalued, and I can't come to where I believe the company is going to grow the valuation?
Correct.
More so? Yeah, if a company is overvalued, we just simply, if we can't justify the valuation, then we won't invest in a company.
That makes sense.
You're saying that you justify the valuation as ARK, and then there's other fund holders or like private equity or private company holders. They set their valuation too, or who is it set by?
So the way that private funding rounds work is there's always a lead investor for primary rounds. So the lead investor will come in and they'll set a price on the round. So they'll set the valuation, and they'll also set the terms of the round. So the terms are, sometimes you have like liquidation preferences. You'll have like capital stack preferences. So who gets liquidated first. You also will have these, like they can set the terms of how much cash the company can raise on this valuation. So they can say, I'm valuing this company at $100 million, and they can raise, $10 to $15 million on this valuation. And I, as the lead investor, am going to commit some sum. Typically, it's the largest check in the round. So say $5 million. Go ahead and reach out to the other investors and syndicate the rest of the round. Get the rest of the $10 to $15 million.
So that's interesting. From what I'm aware of, that's somewhat similar to IPOs as well, right? Where instead of a lead investor, it's usually like a bank or some big firm that kind of leads the IPO, and they kind of set the valuation, maybe at the stock price, and then eventually they, it goes public, and then the market kind of gets a feel for it. Is that kind of a fair analogy, just so we can help bridge the gap for the listeners who are more familiar with public markets, not necessarily private markets?
Yeah, I would say that's a pretty fair comparison for the most part. And, ARK, we don't lead rounds on the private side. And so we're always going to be follow-on investors in private companies. So, sometimes it is subject to the valuation that someone else is putting in place. These investors are smart investors that are leading as well. So I would say large majority of the time, the valuation makes sense. But sometimes the valuation is just absurd, and if we can't justify it, then we won't invest in that round. And there's the counterpart. Sometimes companies are undervalued as well. So, which can also be, maybe a bit of a red flag, because why are you valuing the company so low?
That's fair. Yeah. And I think we touched on this a little bit in episode 41, where just kind of highlighting the differences between private and public markets. With private markets, you kind of have like a temporary window where you can buy into the deal, right? Compared to public markets, you can go and buy a stock whenever you want, as long as the market's open. So do you have any insights around that time pressure, with what ARK's facing, especially if you're kind of indecisive on a valuation? How do you guys kind of handle that pressure?
Yeah. You need to be quite decisive. And I think it's, with investing, it's going to be very black and white. Oftentimes, either it makes sense or it doesn't make sense. And if it's on the edge, then it doesn't make sense. You need to have conviction fully in a company. I would say, typically the way that it works, there's really two-ish ways that I think about this. So sometimes the investor will reach out while they're still circling for a lead, trying to get a term sheet in place. The term sheet is the terms on the deal and the valuation, and someone saying that they're going to lead that round. And so if you have those conversations prior to the lead being in place, you have plenty of time to do the due diligence, dive in, and then, you're kind of waiting for the valuation to come in, which is kind of that last checkbox to make sure that everything makes sense there. And also sometimes the leads will, can somewhat decide the amount of allocation you get in that round. So if it's a round that they're doing $10 million and the lead wants to take $7 million, but there's 5 investors interested in taking, $1 million or so, there needs to be compromise somewhere. So that's another thing to consider. But, typically these term sheets have a close period. So they'll have a date that the close has to happen. So, it could be anywhere from, 30 days to 90 days that you have to fully do the due diligence, and execute on that investment and decide if you're in or out. But yeah, you're right. At one point, it's going to close. That round will no longer be available.
Gotcha. Do you see, so like tokenization is a topic that's kind of been coming up where crypto will potentially allow people, maybe your average investor, to participate in private companies, like investing in private companies. For example, Robinhood recently announced that they were going to, they have a tokenized stock in a sense where you can invest in or get a share of equity in a way into OpenAI. And it's something they're kind of exploring, is allowing access to invest in these private companies before they're officially quote unquote public through this crypto blockchain technology that they're kind of using. And I'm curious to get your thoughts on that, Chase, like how you see that playing out, if you see it playing out at all, because clearly the private markets are pretty complex, especially when it comes to maybe even the smaller deals and like the less well-known names in the private market. It's like, if these deals are kind of tight when it comes to like the windows that they allow people to jump in, I'm curious like how they would even kind of link that tokenization technology to these other private companies. Do you have any thoughts on all that, or where this technology is going?
I have a lot of thoughts there, actually. But probably the best answer I can give you now is I'm in the process of writing a blog that it talks about all of this, exactly what you're saying.
Okay.
And I can send it to you, and I don't know, maybe you could link it below the website or below the episode or something like that. I think that it's the actual way that they're doing the tokenization is very nuanced and quite complex, and it's probably easier written out and maybe with some graphs and figures to fully understand versus me talking through it. But
we do have a little bit more of like, and also international viewers and listeners. And I think to add to what Josh said and what you were saying is it's also allowing international access to these American companies through a stable coin, or, like the USD coin. Is that, can you maybe talk a little bit about that? Like how does that all go through? I know we had Robinhood explain it a bit on how they're going to do it in their platform, but if they successfully do it, which I think they are others are going to follow the lead on that and allow, like European Union or like European people to be able to have access?
Yeah, it's a bit of, some of it's a bit of a gray area as well, because, there's not a ton of securities law around the tokenization of assets. And I think that a lot of that's going to be developed in the next year or so. I do think that the technology itself is very good. I think that it's a great application of crypto. There's a lot of ways you'll see being spun up over the next 12 months that allow people to get access to private markets, even outside of tokenization. You look at, there's European funds that are being in the process of being spun up right now, quite a bit of these private funds that are set up. And you also see, I would say my simple answer is yes, I think that it's going to work somewhat. I don't think that the way that it was done through the OpenAI Robinhood transaction was probably like the cleanest way to do it by any means, personally. I mean, you guys all have X. You saw that there was like some back and forth between OpenAI and Robinhood.
For context to the audience, OpenAI did put out a tweet after Robinhood announced the tokenization saying that they have nothing to do with it. They kind of distanced themselves from that launch. But from what I understand, and I don't know if you can comment this, Chase, but basically Robinhood had equity in OpenAI, and they were basically just using crypto to kind of give people access to their equity of OpenAI through that technology. So it is kind of a gray area, and they're trying to pioneer that space. And of course, the early stages is always going to be maybe kind of, there's no one way to do it yet because it's still brand new, right? This technology's just hit the market, so to speak. So I'm curious, like, if you have any insights around all of that.
They say that they have the equity. I don't know. OpenAI says that they don't own equity in them, which is the thing that, makes me a little bit hesitant around it. And, I'm really big fans of both companies. So it's kind of one of those things where it's like, picking your favorite child and who you support on that side. But I think that I do think that there's a right way to do it. I don't think that was probably the right way to do it, just to be transparent, to do it without having the approval of the company.
Also, I think, this isn't Robinhood. I think they're a broker, right? Like a brokerage. So it could be, and this is just, maybe an assumption or don't really have the detail on that, but it could be that they have a bank that has the equity that they have access to, and they're brokering that transaction through, tokenization, and maybe leading the way on that could be.
Yeah, I'd say anything. I mean, it's always possible with the details, like who knows. But I think to Chase's point, especially with private companies, it's like, yeah, I mean, Chase, you work with founders, you talk with founders all the time. It's like, do these guys want, or do these people want companies, just random companies, kind of tokenizing their equity into the public? Because, like, to be fair, like, that adds some more pressure to the company as well. Like, a lot of these companies are still in the early stage, and like, they don't necessarily want the pressure of public investors. Maybe they want to just focus in on building without having to worry about, just the public backlash of how investors act. I mean, you look on Reddit, anything's kind of possible when your company's public and has access to public markets.
Yeah. I think that the problem with the only problem, I'm not speaking for all the founders I work with. I'm sure that if it's done proper, there's several founders that would be, excited for this opportunity. And, you see companies like Securitize that are tokenizing a lot of private assets right now. And that, it's clear, I hear something about them all the time, and it seems like they, are crushing it. And a lot of people were very big fans of what they're doing. And I know that they're continuously signing contracts with, several big banks, several big companies to help securitize private assets for them. So it's not for a lack of want in the market. The one thing that I do worry about is, like, with a limited supply, and part of the reason that private markets are very complex, but also pretty simple in some ways, is like, there's the window to invest in a company. And then once that round is closed, you have to wait for the next window. And, at ARK, we mark a NAV daily of the fund's assets, so net asset value of all the underlying assets in the fund. But most funds don't. Most funds, the company raises at $100 million valuation. That valuation essentially stays the same, stays flat, until the company raises money again and the company is repriced at a new valuation. So there's really not the volatility that you have in the public markets, where prices are changing every single day for a majority of these investors. The issue is say I own company A and I tokenize it, and there's 1,000 shares of company A. The company is valued at $100, and these shares, I tokenize 100 of these, or say $1,000 share. I tokenize 100 of these assets, and it gets really excited, and sharing back and forth and transferring, and the price in that tokenized asset shifts up to $5. Maybe the underlying value of the company is still at $1,000, but it's trading on this secondary, exchange of tokenized assets at a $5,000 price point. And then at some point, someone's left, holding this asset that's overvalued, that no one's going to purchase, and it's not tied to any underlying value of the company. You still own the shares, but it's way overvalued, and no one's going to purchase it for that price.
So it's like it's a supply versus demand situation, where it's like, for example, Robinhood said they had like a small basket of OpenAI shares, but it's like, if everybody charges to get equity in that small basket and they drive up the price, it's like, is that the true valuation of that public or that private company? It's like, I don't know. So, like, yeah, I could see that kind of being a gray area. Yeah,
without new shares being issued, it makes it difficult to trade those shares. And I think that, and that's part of the, that's part of the issue. Like, if the shares don't tie, the price of the share doesn't tie directly to the value of the asset, and it's trading much, much above, higher than the actual underlying value of the asset that the market's pricing it at, that's when there's a problem. And I do worry that can happen sometimes when you're doing like these very small batches and allowing for them to be traded back and forth between people.
That makes sense.
What do you say? Go ahead, Pierce.
Well, my question is kind of like an oddball question. I can't get it out of my head right now. So, I mean, obviously private equity, it's all, it's not 24/7 trading like some things are, talking about, like the tokenization, that's 24/7. Are we close, and do you think we'll ever see a world to where private equity, all the VC funds and stuff like that are tradable 24/7 for like normal investors,
Yeah, I mean, transparently, Probably not. I don't see that being like in the near future. I do think that I wouldn't say all of the funds. I do see a time where it's, potentially possible in the future where some of these are available to be traded more frequently. But I don't see it, the reason that everyday people can't invest into private assets is because there's accreditation limitations. You have to be either an accredited investor or for some funds, even a qualified purchaser, which have different, metrics that you need to have, whether it be net worth or assets that you own to qualify to invest in private companies. And, I don't really agree with accreditation status as the primary driving factor for like deciding who can and who can't invest in private companies for the most part. I do understand the original thought process and reasoning there. It's to avoid people from getting scammed and losing their hard-earned money.
For sure.
Private markets are very, very volatile and very risky. Early stage investing, especially, investing in early stage venture can be very, very risky. So, it's my full-time job, making investments and picking private names. And it's not like I have 100% track record on, picking the best companies in the world every single time. And the best investors in the world won't, you're going to have companies that fail. And when you're picking individual names in the private side, that's where it gets really, difficult. I think investing into funds that are investing in private names for you, where someone is spending, a lot of their waking hours researching private companies and investing in these private companies and maintaining these relationships and knows all the nuances that you might not have the time to focus on. I think that's where I kind of get to the point where I'm like, I don't know if I agree with not allowing accredited investors into funds themselves if they understand the risk. And maybe there's like some kind of new high level test or something that someone has to pass, just showing that they understand the risk and they understand the volatility and they understand the way that private markets work, even if it's at a high level.
Yeah.
But I do understand the reasoning for not allowing people to invest in, one-off private names. I've done some angel investments in my life, and some are great, and some you've never heard of and never will hear of.
Yeah, for sure.
Is that would that be considered like a federal regulation, or is that set by the company itself that holds the fund, or
Yeah, it's a federal regulation. It's set up. There are different fund structures that you can utilize that allow for non-accredited investors. You can't take. So the way that venture funds work, like a traditional venture fund, you take 2% management fee year over year, and 2% of the total assets that you manage as a management fee. That's for like a lot of your, salaries, overhead costs, stuff like that. And then you take 20% carried interest. Carried interest is if my fund is $100 and the fund returns $200. First, I have to pay back that $100, the original principal, and then I can take 20% of that leftover 100 as carried interest, and that comes to me as payment as well. So the better you perform as an investor, the more money you make on these funds. You can't take performance fees, so the carried interest fee on vehicles that are open to non-accredited investors. So I think that's part of the reason that a lot of people don't do these other fund structures that are available to allow non-accredited investors into the fund. It's also much more difficult to raise, say, $100 million in $500 tranches from people versus raising $100 million from 12 very wealthy people. Or
that makes sense.
A lot of people are, and I think you mentioned it on our last episode. A lot of people look at the story of Uber, and that kind of just builds that motivation to get into the private market. Would you say that's possible in today's world to invest $60,000 and make $17 million out of that?
I'd say anything's possible. I wouldn't say, that's a bit of like a gamble bet in a lot of ways. And that still is very risky. Like I said, investing in individual names is much more risky than investing in a fund. And I wouldn't invest any money that I couldn't afford to lose into an individual one-off private name, personally.
Chase, I'm curious, and I'm not sure if you how much insight you can give us around some of the funds. So feel free to just tell us what you can. But I'm more curious around, clearly private companies are significantly riskier than maybe your traditional public companies. And for one, like we all like funds here. Like we talk about ETFs, index funds all the time. So like we're big fans of those, especially in the public market. Now in the private market, I'm just trying to wrap my head around kind of like the idea behind them. Cause it's like odds are like based on just, based on math, like most of the companies in the fund are probably going to fail or not survive, 5 years from now. So when somebody's considering a private equity fund, should they go in with the mindset of, I'm going to look at these, maybe 10, 20, however many companies are in that private fund. And it's like, you want one of those to basically 100x essentially to kind of carry that fund. Is that kind of like the idea around these different private funds? It's like you're kind of, in a way, accessing, kind of approaching how traditional venture capitals kind of people do these investments where they kind of buy like 20 different companies and they're kind of banking on just one carrying the whole portfolio. Would you say that's kind of similar with how you would want to approach these funds, these private equity funds? It's because like clearly like most of them are likely not going to do well or fail 5 years from now. So like you're kind of banking on one or two of those to kind of hit in a sense. Is that kind of fair to say it?
I would say yes and no. The best way to think about it is like make a divide between like early stage venture, like seed stage, pre-seed. That's more so what you're talking about. Those funds, people are going to only invest in companies that could return the whole fund at least. Each company they invest in should be able to return that in the entire fund. Now, obviously, they're not going to go into any of these investments thinking they're going to be losers. They need to have the conviction that each of these funds or each of these companies is going to return the entire fund. And it's a really solid investments. When you're looking at later stage companies, some of these companies are profitable and continuing really good growth. And the likelihood of some of these later stage companies going out of business is probably less likely. That said, there's still the chance that they go out of business. Even public companies go out of business. But and I would say that later stage venture is still going to be more risky than public companies, but it's going to be less risky than these early stage ventures. So it really depends on, I would say that when you're looking into funds, and if you were to look into making investment into like a venture fund, understand like what's the profile of company that these guys are making investments in. Are they investing in like very early stage companies that are, pre-revenue, maybe even pre-product? Maybe they're very like, some funds invest in like idea stage companies. And the earlier the company, the more likely it is to go out of business, just to, and it's going to be more risky, but your potential upside in that company is going to be higher. It's a simple risk reward measure. Whereas later stage is going to be, the opposite of the end of the spectrum. It's still going to be risky, but it's not going to be as risky. I mean, you still could have, potential high returns and high reward in some of these investments, but it's not going to be as high of a return as potentially like the earlier stage. So it's really like, I always teach this. I used to manage a scout network at my last job, where I had like 150 venture scouts. A venture scout is someone that's, affiliated with the company, the venture fund. And what they do is they're kind of like an ecosystem, maybe it's leaders, or they just attend a lot of startup events and pitch competitions and things in their ecosystem, and really like connectors. And they keep an eye out for good companies that are on the rise in these ecosystems. And this is really a good thing to have for funds that are investing in earlier stage companies. And also, if you're ever, interested in venture capital and looking to like break into venture and get a job at venture, I would say that's a very good way to get your foot in the door and get some exposure, maybe get some education around venture in general. And it forces you to be a member in your local startup community is, reach out to some local funds and say, I'd love to be a part of your scout network. If you don't have one, I'd love to start sending you guys some deals. I attend all the community startup events and see a lot of good deals. And that's a good way to kind of, get some at-bats and get that connectivity. So I always get asked, what's the best way to break into venture? I think that that's probably, in my opinion, a good starting place.
Yeah, that's super actionable too. Because like you said, it sounds like you could do a quick Google search wherever you're located. It's like if you're in Washington, for example, just search it on Google where maybe the local meetup is and jump into it there, right? Like I'm sure you're going to meet people like Chase who are passionate about this space and want to learn more about it and really dive deep into it. And maybe you can learn stuff yourself, right? It's like, I think, thanks for sharing that, first of all. And if anybody is listening, take advantage of that. Like that's a free tip to actually implement and take action on?
One thing I would always teach them, and I would do every other week, I would do a training and try to go over like a framework. I'm a very big believer in like utilizing frameworks for just optimizing the way that you think through things. Sometimes it slows down my thinking so much, and then if you're ever stuck on a problem, maybe look up a framework for it and see if there's a framework to help you solve that problem, because it can really optimize the way that you're making your decisions. But I have this framework that I use for risk, which is a very simple one. I think of my measurement for risk is like a cup, for example, or glass. And the amount of risk I'm willing to take on is only as big as my cup is. So if I have, maybe I have a much larger risk than Fernando does. Maybe Fernando's cup is the size of like a thimble, and mine's this big. And maybe, Josh, your cup could be a 5-gallon water cooler that you take to a football game. But I think understanding your limit, like your limit for risk, and then what you do is you give that individual thing a risk measurement. So you say like, this is very, very risky. So this one thing might fill up my cup for my financial risk for the whole year, or for this lump sum of money. So if I do this investment, then I can't take on any other risky investments for the rest of the year because I'm capped out and anything will overflow my cup. Or maybe it's a quite small risk, and so it's not going to really affect my limitations for risk. So I think that if I could give any advice to another piece of advice to the listeners, I would say like, sit down and understand like what is your capacity for risk. And everyone's going to have different capacities, and some people, their risk is going to be much larger because maybe they just have that ingrained in them. But also, a lot of people have responsibilities, and so the more responsibilities you have tied to you, the smaller your capacity for risk is going to be.
That's a good point. You don't want to be using your rent money to take high risk and hope something kind of plays off. So definitely make sure you're aware of your risk level. That's wise advice right there. So yeah, Chase, first off, I really appreciate you sharing all these insights. And I think it's interesting personally just to see the different areas in the private equity space, whether it's the early startups or more of the late stage startups who might be close to IPOing in the future. Like you can clearly see there's a risk difference, right? Like the people like these seed stage startups, the people who are just maybe starting their business, they're going to be significantly riskier than maybe something like OpenAI or SpaceX, which are more established. They actually have posted results, like they actually have a track record, and they have high potential of maybe going public one day. Like there's a clear risk difference. And I love the discussion of like risk versus reward. And we do circle back to it quite a bit on this podcast. It's like, of course, like the higher risk you take, there is more chance of more reward. But at the same time, it's like there's also more chance of you losing all your money. And at some point, you cross the line of just purely gambling. It's like you got to be careful and make sure you're kind of approaching it. And I like how you highlighted the frameworks. Like using these frameworks is powerful because it'll kind of protect you from making decisions that maybe you'll regret later. So I appreciate you sharing that. We are kind of hitting up our time. These conversations always fly. So before we officially wrap up, Chase, is there anything else you'd like to share with our listeners as like a last tip or just a last insight to leave us all?
Yeah. Did you have a question? When I cut off someone when I was talking through the risk frameworks,
Oh yeah, I think Piers.
Oh no, you're good. I think the question was kind of based off of Reg A's. Like, do you see ARK using Reg A to launch more things again? To like, because from my understanding, Reg A makes it more available to like non-accredited and like kind of normal people who don't have $100 million or $5 million to invest in a fund. So that was kind of my question.
Yeah, Reg A, I don't think we would ever use Reg A, just to being honest. But it is a good option. People should research it. There's a lot of nuance in Reg A. Essentially, it's like a public, that fund is like a public traded company. Essentially, is the way to think about it. And there's also Reg CF, which is an easier way to do it. I don't think that we will use Reg CF either. And look up the ARK Venture Fund. If you go to ark-funds.com, you can look at the ARK Venture Fund, and we have all the details on our website around like what companies we hold in the fund and the way that it's structured and the nuance of it, but the fund is structured as an interval fund. So interval funds are kind of like a cousin or sister to a mutual fund. And so it's, I do, do your own research there. We have plenty of information on it's ark-funds.com. And, I think that I also, that's where the blogs I write around venture are going to be linked, is on that page as well underneath resources. So I actually posted a blog recently, Pierce, around Reg A versus Reg CF and the nuances there. So if someone wants to learn more about one of those structures or both those structures, it's like a 5-minute read. And I think I break it down like pretty clearly for the most part.
Awesome. Thank you.
Yeah, we'll have to leave your link to the blog in the bio of the podcast so people can check it out.
At the beginning of this call, you had mentioned, the markets are, trending positive. I would say, yes, I agree. I think private markets oftentimes are like a bit of a lag to public markets in a lot of ways. We're starting to see a pickup in M&A. And so I think that we're starting to see some liquidity in private markets for people. The problem with it is that with private markets for the last 2 years or so is a lot of people invested in these funds, and then they haven't been able to get their money out of these funds ever, even though they maybe have exceptional returns. So they're just sitting on these returns, but they can't get the cash back. And so these markets are going to be very cyclical. You put cash into a fund, you get your cash out of the fund. You put your cash back into a fund, you get it back out of the fund. But when you put the cash into the fund and it takes forever to get your cash back out, there's no cash to cycle back into new funds. So it can slow the investment activity in private markets. We've started to see that picking back up in private markets. TechCrunch does a great quarterly update. So they did their Q2 update. I think it's worth, if anyone has the chance to go through and read it, it's a pretty quick read. If you look at the overall capital invested into private markets, the last Q2, Q1 of this year, you would look at it and say, oh, wow, private markets are back. They're really back. But when you get into more like the details of it, majority of capital is invested in a very select few names. And if you look at early stage venture this year versus last year, and you take out those, especially if you take out, the top 15 names that are getting majority of the capital in private markets, you're actually, net, like essentially flat year over year. And last year wasn't the most amazing year for private investing either. So, but what you're seeing is a lot of consolidation into these top names, and you know the names, and they're raising billions and billions of dollars, and they're raising it, and it makes the activity look like private markets are much more back than they are in some ways. But I do think that I don't shy away from the fact that it's a tough funding environment for early stage founders. And it's a grind for these early stage founders to raise capital, especially if you aren't a big time name and have, $1 billion exit underneath your name, and maybe a first time founder, it's going to be a grind to raise capital. And, there's a lot of respect that I have for these early stage founders that are out there, grinding, taking hundreds, if not thousands of calls with venture investors to, get that seed money in.
Oh yeah, I could only imagine. It sounds so. Do you see a lot of people in the space kind of becoming more cautious, and that's why they're kind of heading more towards the bigger names, like staying away from the smaller companies, because maybe the past, like you said, the past couple of years, private markets have kind of seemed to just basically halt. Like there hasn't been much activity, and now we are starting to see some activity. So do you see people like maybe the early stages, as some of these investors are trying to pull their money out of the riskier stuff and just kind of sitting with more of the top dogs in the private market space? Is that kind of the activity you're noticing?
I wouldn't say that they're pooling the capital. I think that, people that are going to invest in early stage venture are probably going to continue to invest in early stage venture for the most part, unless they, unless something dramatic happened and they didn't see, good returns, or they just didn't love their capital being tied up for that long. But the majority of these people that are going to be, I would say intelligent investors and know what they're doing. And so I think that it's just, we're waiting for capital to continue that cycle to coming back to these early stage investors and these early stage funds. And I think that, we're also seeing more solo GP spin up, which are raising smaller funds. And, those are the people that really fuel the broader venture ecosystem. These large mega funds that are household names that everyone knows of, it's amazing to have one of them on your cap table, and they, provide a lot of resources, and even just the brand value is amazing. But, I do believe that like these people that are willing to take bets on founders at the very start, really deserve, I would say, probably even more respect than they get, because, they're taking a lot of risk with their own name, and they're taking, a lot of risk with these investments they make. And you have to be, it's not like if you raise a $10 million fund, you have a lot of, you're not going to be, most people aren't going to be a billionaire fund, or like even a multi-millionaire. Like, even if you have amazing returns, like these people are in it for the love of the game oftentimes. And I appreciate that.
Plus the odds are stacked against them, right? So like not only are the odds stacked against them, but they're pushing through it, which I agree. Like you got to respect that.
Yeah. You mentioned M&A, and then just for the audience, like mergers and acquisitions, it seems like there's a lot of companies doing that right now, where it's like the thing now, M&A, it's happening a lot. When you mention M&A, like, do you say like if you're in that fund and a company that you're investing in, a private company you're invested in, gets merged or acquired, what happens to your fund? Do you cash out, or do you just take that company in?
Yeah, I'll just use like a traditional 2 and 20 venture fund for this idea. And so if I'm an investor in a company and it gets acquired, I'm an investor in a fund that's an investor in a company, and that company gets acquired, and say it's a good return. I get like a 2x on my capital in that one company. And over like a short period of time, that just gets returned to the fund, and then it's distributed back to the investors. So, if you 3 were investors in my fund, and I would say I was the 4th investor, we all had $100 in there, all in, and one of our companies got acquired for $200, I would distribute the capital back to you guys first, paying the principal back to you. So I would give everyone back $25. And then from there, I would take my management fee, the 20%, or not my management fee, my carried interest, the 20%, and then I would distribute the rest of the gain to you guys.
Interesting stuff.
It's like as straightforward as you could think it would be on that side. Yeah.
Good stuff. Well, Chase, hey, it's been a pleasure to have you on the podcast. Back again to kind of dive into more of the details. Appreciate you taking the time and sharing your perspective. That being said, that's a wrap for episode 53. 53. If you want to go listen to the original episode, go listen to episode 41. Chase shared some additional insights, more high level. I feel like this episode we dived a little bit deeper into some of the nuances, which is great. And again, I can't appreciate Chase enough for coming back, spending an hour with us and sharing his thoughts. That being said, make sure to follow Chase on X. We'll be leaving his X handle in the podcast summary, as well as his blog. And Chase, you said you have a blog post coming out soon on the tokenization part of the side of the market, right?
Yes.
Okay, I'm going to read that one.
Yeah, I like to think I post valuable content. I was on the blog side. Maybe sometimes my tweets are less.
And to everybody in the audience, to mention, like, if you want access to any of these funds, you can go to the ARK website, ARK Invest, as well, and look into any other funds to where to get started. I know many people want to know where to get started, right? So you have access to those funds.
Yeah, just do your research. Be smart. Don't put all of your money into funds that are super risky. And like Chase said, use frameworks. I love the framework analogy of figuring out what your risk level is. The cup analogy is good. If you have a small cup and you realize that you can take a little risk, but once that risk is full, stop. Somebody else, somebody who has a 5-gallon jug, they're going to be able to take a lot more risk. And just because they're taking more risk doesn't mean you need to as well, right? You got to understand your own risk profile. That's super important. We talk about it very often on here. So always keep that in mind. But then again, to Fernando's point, remain a student, right? There's a lot to learn out there. There's a lot, we're learning. That's why we love bringing Chase on, because I'm learning myself. Like we're learning more about these markets ourselves, which is great. But again, Chase, can't thank you enough for coming on here. And to the Market Hustle audience, if you found this episode valuable, make sure to leave a quick 5-star review. We really appreciate your feedback on whatever podcast platform you're listening to. And we'll see you back in our next episode. This episode 53 is officially a wrap. We'll talk to you later. Bye-bye.